I'm the Director of Private Pensions here in the UK Government in the Department for Work and Pensions. And that means that I also have responsibility for the automatic enrolment programme here in the UK. As I was kind of listening to David Halpin this morning about, one of the first things that we kind of need to do as kind of policymakers with interest in behavioural insight is to win the argument about the importance of behavioural insight. I kind of feel those of us who are in the kind of pensions and savings world have a bit of an advantage in terms of, it feels to me that almost all of the ideas that are coming out around financial engagement, getting people to save more in pensions, bridging the savings gap, almost all in this space of behavioural insight. And so what we thought we would do today is think a little bit about the challenges that actually we face in this area kind of moving forward. And then we've got 4 great speakers to talk about their ideas about where next in this space. And I was looking at the speakers who are going to introduce in terms of what they're going to do, and I realised that I had stolen ideas from 3 out of 4 of them, and that's only because I only met the 4th one today. So I'm hoping to be able to kind of complete my set. Before I hand over to the first speaker, I thought what we'd do is just really kind of, for those of you who don't know what's going on in the UK, we have been running the automatic enrolment programme into pensions for the last 3 years. And it was a programme very much influenced by behavioural insight and behavioural economics, and continues to be so. So it's not just the broad idea, but almost everything that we do, the way that we design all of our materials, the way that we try and engage with employers, all kind of influenced by behavioural insight. And what we've seen over the last 3 years is we've managed to get 5 million more people saving. So we've rolled out to all of the large and medium employers in the country, and are just starting the kind of slightly daunting task of rolling out to the 1.8 million. So we've done 50,000 companies, which feels a lot, and we only have 1.8 million more to go. But one of the things that, one of the takings I take from the auto enrolment programme is it's much more successful than we thought it would be. A lot of the kind of analysis that we did and what we thought would happen, actually the results have been much more successful. We've been more successful in getting people to save, so our opt-out rate is much lower than we expected it to be. The compliance of employers is much higher than we expected it to be. There's kind of social norming around saving, which is growing over the years. That said, there remains a number of rather significant challenges for the UK around savings. We have increased coverage, but not to all groups. So there still remains to be large undersaving around self-employed people. A growing kind of focus on middle earners. So actually auto-enrolment and the state pension really kind of deal with low earners, and high earners tend to be quite good at sorting themselves out. But actually, what are we going to do about those people in the middle who perhaps could be a little bit complacent about automatic enrolment and where it may get them? And increasingly, I think the issues around social care, rainy day savings, precautionary savings, kind of coming to the fore, that we may have kind of got a good basis with regards to retirement savings, but not so much in terms of the other kind of areas of savings that we probably need to focus on. The other big reform that's going through in pensions at the moment is what's known as the freedom of choice reform, because you've got to have a good name for these things, which is around kind of decisions at retirement, and they're actually not using behavioural insight and giving people more options and starting to analyse what the impacts of those are. Now, knowing what the people who are coming up after me are going to say, I think all of those things are going to be kind of addressed. So I will invite the first speaker. So the first speaker is Brigitte, Professor Brigitte Madrian from the Harvard Kennedy School. Is that right? Sorry. And many of you will know Brigitte's work in terms of, I certainly do, and have stolen from it, in terms of automatic enrolment and looking at the impact of automatic enrolment and financial decisions at the household level. So please welcome Brigitte.
So we were, all of us on the panel were asked to come up with our next great idea to bridge the savings gap. So I'm going to spend a few minutes giving you my idea, after which I think all the other panelists will give you their idea, and then I've been told at the end you guys are going to vote on who has the best idea. So I am going to freely give you my really good idea. And we'll see what kind of reciprocation happens at the end of the panel. Okay, so I'm going to talk about rainy day savings, and I'm, as Charlotte noted, I'm at the Harvard Kennedy School. As you can tell by my accent, I'm from the United States, from the other side of the pond, not this side of the pond. And one of the problems that we have in our retirement savings system, which we're still trying to get a handle on how peculiar this is to the US relative to other countries, but one problem we have is that it's very easy for individuals to tap into their retirement savings before retirement. So it's been estimated that for every $2 that's going into the US retirement savings, $1 leaks out by individuals age 55 or younger, well before they're getting to the age of retirement. Now, this poses obvious problems for retirement income security, and so we've been thinking about how do you get the money to stay in the system. Now, of course, the question is, why are people taking money out of the system? And one reason, of course, is because they can, and the second reason is because life happens. People experience financial shocks that require immediate expenditures today, and they raid their retirement savings account because they don't have anything else set aside to cover all of the stuff when life happens. So survey data from the US, if individuals are asked, have you set aside emergency or rainy day funds that would cover your expenses for 3 months? 40% say yes, 56% say no, 4% don't know or answer the question. This question has also been asked in the UK, and my understanding is the fraction of people who say yes is even lower than 40%. Another way of looking at this is to ask individuals, how confident are you that you could come up with a certain sum of money? And in this case, the amount in the question was $2,000. In the, I don't know exchange rates off the top of my head. What would $2,000 be? 1,300 pounds, 1,500 pounds, somewhere around there. So that could be the cost of a car repair, that could be the cost of fixing a leaky roof. There are lots of things on that previous Life Happens slide that could cost you $2,000 or 1,500 pounds. So how confident are you that you could come up with this sum of money if an unexpected need arose within the next month? So basically, you've got 30 days to come up with this sum of money. How confident are you that you would be able to do that? So in the US, 35% say, I am certain I could come up with the full amount. 21% say, I could probably come up with that amount. So a little bit over half, 56% say, I definitely could, or I could probably come up with that amount of money. And 40% say, there is no way I could come up with that sum of money. This question has been asked in the UK with an amount of 1,500 pounds, and the statistics are worse than for the US. Fewer individuals say that they are confident or pretty confident that they could come up with that sum of money. So this suggests that we've got a problem. Individuals, while I and Charlotte and others have been focused on retirement savings, which is a noble goal, there are other reasons that people need to save, and they're not doing a very good job of that, and at least in the US, one implication is they end up raiding the retirement savings piggy bank. So my great idea is to set up a system of parallel savings accounts, a retirement account and a rainy day account, to help satisfy both of these savings goals, and to do it in a particular behaviorally informed way. So the way that I propose doing this is, first of all, do it through automatic enrollment. So harness the power of automatic enrollment, which we know gets people to save for retirement, to also help people set up a rainy day savings account that they can use for everyday expenditures when emergencies arise. Setting them up in parallel helps exploit the power of mental accounting. So it clearly designates one of these accounts for retirement savings, and by having another account for other stuff, it limits the effective budget available for that other stuff to the amount that is in the other stuff account, and psychologically segregates, creates a barrier to using the retirement savings account for purposes other than retirement. And then the third feature of this, and I think this is the innovative feature, is there would be two separate accounts, but they would be funded in an integrated fashion. And what I have in mind is designating a savings rate. So let's say 10%. We're going to take 10% out of your paycheck to fund these two accounts. Now, a very simple way to do this would be to say, well, we're going to take 10% out and we're going to put 5% in the retirement account and 5% in the emergency account. One could do it that way. I'm going to suggest that that's probably not the best way to do it because, you know, retirement is going to be pretty expensive for most people. I would like to hope that most of the emergencies in people's lives are not going to be quite as expensive as retirement. So then you could say, well, let's put 8% in the retirement account and 2% in the emergency savings account. I'm going to suggest something a little bit different, and that is to take an amount, let's just say 10% hypothetically, out of your paycheck, but we're going to dynamically adjust how much goes into the retirement account and how much goes into the rainy day account based on how much is in the rainy day account. So the idea behind the rainy day account is you need a certain level of precautionary savings that's going to help you cover those unexpected expenditures. But those, you know, for really big unexpected expenditures, people get insurance. If your house burns down, you don't save for that, you buy an insurance policy for that, right? So you don't need, you know, thousands and thousands and thousands and thousands and tens of thousands of pounds or dollars in your emergency account. You need enough to cover the stuff that insurance is not going to cover. So many financial planners would say you need 3 months of pay in an emergency account or 6 months of pay. So the idea would be to have these two accounts linked, have a certain fraction of your paycheck that's always going to the retirement account, and then fund the rainy day account until it gets to this threshold level, the 3% of pay or the 6% of pay, and once you reach the threshold, whatever was going into the rainy day account then gets transferred over to the retirement savings account. When an emergency happens, if you then take money out of the rainy day account, the balance falls below 3 months of pay or 6 months of pay, whatever is deemed appropriate, then a higher rate of contributions would then be put into the emergency or rainy day account until you get back up to this buffer stock. So the two accounts would be integrated so that you could have this dynamic adjustment in the contribution rate that is helping to facilitate both retirement savings and facilitate emergency and rainy day savings in a way that hopefully helps individuals both better prepare for retirement and better meet the unexpected day-to-day financial shocks that hit because life happens. And that's my idea. And now I guess I'm turning it back over to Charlotte, right?
Right. Next up is Matt Oakley. Matt works at the Social Market Foundation. Prior to this was Chief Economist at Which. So hopefully we'll get a good consumer angle.
Good afternoon, everybody. So I should probably start with saying who the Social Market Foundation are, given that there's people not from the UK, and even if you're not from the UK, you might not know. So the Social Market Foundation are a Westminster-based think tank, come up with policy ideas for government, for industry, for business, for everyone really, to try and make people's lives better, essentially. We're not for profit, so get money from kind of trust foundations, that sort of thing. So everything we do is for public good. So what I want to talk about today, and I should confess that I'm cheating slightly, and I've got two ideas. Please don't halve my votes, because I think that'd be wholly mean. But I want to talk first a bit about how I think about this problem, and that kind of says why I think that I need more than one idea. First of all, I think it's clear that this is really, really important, particularly in the UK context, I think, although it's probably similar across the world. Savings are incredibly important for financial resilience, and that's true across both the life cycle in terms of pension savings, long-term savings, but also across the economic cycle, and that's both true in terms of individuals' economic cycle, so we have something broken down, or we become unemployed, or the macro economic cycle, so as a country, are we managing to smooth our income across the recession, etc. This all means that there's very strong links between savings and having adequate savings and consumer welfare, utility, if you're an economist, and also wider links to things like the use of payday loans. If we don't have enough of a buffer stock, we might go to payday loans. As we all know, that leads potentially into a spiral of debt and that sort of thing. So really can help increase consumer welfare and utility. The problem, as we've already heard, is that as a country we're not saving enough. What we usually think of as policymakers, we usually sit around and say we have a savings gap problem. How do we plug that? And what I think is that we don't often cut it down enough and think about the different groups that are involved. Now, I'd argue there are three different problems here actually. There are some people that aren't saving at all. So 1 in 4 UK households have no savings whatsoever. A second group of people who are saving but not saving enough. And if you ask the population in the UK, around half are worried about the level of their savings. So as a group here, we're slightly more confident than the UK population as a whole, but still not doing so well. And thirdly, I think this could be where I bring up something different to some of the other speakers, is where people might be saving enough, like I think it was 60% of you, but do you know that you're making the most out of that saving? Are you getting the return that you should be on it? And if not, why not? So there's 3 dimensions, I'd argue, for the savings problem in the UK, but also kind of 3 kind of different bits of that problem. So first of all, there's short-term, rainy-day savings we've just heard about. Secondly, there are savings to reach a target, to buy a new good or a new service. And thirdly, there are issues around pensions we've heard about. So all in all, there are 9 different problems we need to tackle as policymakers. And as any good policymaker knows, you can't tackle 9 problems with 1 measure. So I think we need at least 9. So there's 4 here. I'm going to have another one, so that's 5. So we'll have 5 and 9 by the end of today. So I'd wholeheartedly recommend we say yes to all of them. So I want to cover, as I said, two different areas. First of all, people who aren't making the best decisions with their savings. And I think here the problem is, as with a lot of different markets, is consumer inertia and a lack of engagement. The FCA, the Financial Conduct Authority in the UK, recently polled consumers, and just 12% of respondents said they actively monitored interest rates and would switch to another account if they found that they could get a better rate somewhere. That leaves 90%-ish, 9 in 10 people, not actively managing their savings in the UK. That can have a really large impact on the level of savings that someone has. So, Which did some research recently that showed that by people not keeping the amount, keeping their money in the average in an account with the average of the market, they're losing around £4 billion a year in potential returns. Now, in terms of plugging the savings gap, that's a really large potential gain that could be had just from getting people more active in the savings market. The key problem here for the UK, as the FCA also showed recently, is that firms tend to draw us all in with teaser rates. They'll offer us a very attractive upfront offer, perhaps with a bonus rate up front. So if you keep your savings in with us for a year, we'll give you a 1% increase in the interest rate you receive. And because we're all consumers, we get to the end of that year, and we don't take the action that we thought we were going to previously. We stay there, and we leave our money in that account, which has now suddenly dropped to a much lower rate of interest. That's what drives the consumer inertia, and that's what drives the loss of money, which I've been talking about. So how do we get consumers to engage more? How do we get consumers to, after the end of that year, make a choice and switch? Well, thankfully, that's something that the FCA have been looking at as well, again. And what they recommended through some piloting, some randomised control trials, was that by firms giving information, by firms varying how that information is given and the timing of that information, actually we can increase savings, we can increase the rate of people who are actually taking that active step and engaging in the market. My problem is that I don't think that was going far enough, and I don't think actually we saw a large enough impact of that of the trials in terms of really driving behaviour. And what I would argue is actually, why can't we go further? And if we think that consumers are inert, if we think they can't drive competition on their own, why don't we turn this around and make it incumbent on the firms to drive that engagement and competition themselves? So my first idea would be that any fixed-term savings contract, any account that has a bonus rate attached to it which falls off after a year or after 2 years, firms aren't allowed to default people onto very low rates, very low interest rate bearing accounts. What they would have to do is put people into an account which offers them the average of the rest of the market rate that was prevailing on that kind of account. That means that firms would be losing money, and they'd be forced to get people to engage with them and make an active choice in what they do with their money. I'd argue that's much more effective than trying to rely on consumers, which is slightly odd potentially coming from an ex-consumer champion. But I think, nonetheless, it should be incumbent on firms to try and get their customers a better deal. As the FCA will say, they should be treating their customers fairly. So that's one idea, for how to get people to get more money from the savings that they have. So what about those people who don't save? Auto-enrolment has been a great success in pensions. I'd argue that for the reasons we heard earlier about leakage, perhaps for savings that's not so appropriate, and that number one, people might just take it out and use it, and number two, actually we want people to take out the money for savings to spend on the everyday things that happen in life. So if that approach isn't going to work, what else can we do? I'd argue that a large part of the problem comes from two things. One, around complexity, and two, around uncertainty, which means that people don't understand what they need to save and don't understand what steps they need to take to do that. So actually quite similar to the idea of having the two parallel accounts, what I would suggest as my second idea is harnessing the power of big data, bringing in digital technology, and giving people an online kind of pensions and savings dashboard, which allows them to see all of the savings, investments and pensions in one place, allowing them to understand what they have, where they have it, and perhaps splitting it out into those 2 or 3 different areas, so short-term savings, rainy day savings, and pension savings. And alongside that information, you could also employ nudges, you could also employ some kind of guidance to say, people like you tend to save this much, and this is how much you are, this is how far behind that you are. So can we be nudging people into saving more by using social norms within that framework? Overall, I think it's a really powerful way to perhaps harness the power of social norms, but also just to give people more information and let them make their own choices and really drive their savings behaviour upwards, I hope. So overall, there's 9 problems. Hopefully, I've suggested 2 which will help. One, asking more firms and getting them to not default into really, really poorly paying interest-bearing accounts. And number 2, harnessing the power of big data and digital technology to give everyone a pensions and savings dashboard. Thank you.
I think next up is Paul Todd. Paul is the Assistant Director of Investment at NEST, the National Employment Savings Trust. I don't think anyone ever spells out NEST, do they?
No.
And so Paul, they've been doing a lot of innovative work about how people interact with investments and how people react to investments, and so what Paul has to say.
So, good afternoon. It's great to be at a behavioural conference. Basically, the whole premise of NEST is based on behavioural finance, so I'm in a job because of behavioural finance. So, thank you, and hopefully can give a little bit back in terms of some of the work that we've been doing over the last 18 months about the kind of changing landscape in retirement. One of the big challenges of automatic enrolment kind of going forward is going to be not just getting people saving, but what do people do with those savings when they come to retirement. And in some ways, this challenge can maybe even harder than getting people into saving in the first place. This is quite a complicated kind of area. These are difficult decisions that people need to make, and often they're not equipped to make these decisions, and the products probably haven't been there in the past to meet certainly the mass market. So in the next kind of 10 minutes, I just want to share some of the recent findings from qualitative consumer research that we've been doing in NEST about options at retirement, and what this means for designing retirement products, and how kind of behavioural insights and behavioural finance can help us improve the design of retirement solutions for millions of savers in the future. So firstly, kind of what is it that people want from retirement? So this slide's probably a bit small, but I'll just take you through it. We asked people what were the kind of key features they wanted from a retirement kind of product, and almost overwhelmingly across socioeconomic groups, across different pot sizes, across different ages, the two things that kept coming out on top was a regular income and certainty that their money wouldn't run out. So the kind of concept of security of income was seen as essential. In effect, most people are looking for a replacement for their kind of monthly kind of wages or income when they get into retirement. And when kind of pushed and probed, it's not something that people offer up. People also want some inflation protection, particularly kind of older generations that recognise what went on in the 70s and things. So far from this concept, and this came out very much in the UK, once the freedoms were announced in the budget in 2014, that people were going to be reckless and buying kind of luxury cars and things. Actually, it's not really that surprising. Most people are pragmatic, most people are sensible. They see what retirement saving is about. It's about kind of their income and retirement. So if we think about what consumers are saying, then in many ways everything should be fine, because the UK has the most developed kind of market in the world for delivering exactly the kind of product that when you ask people what they want, we've got it. It's problem solved. I mean, basically what people are asking for is an index-linked annuity. So that should be fine, really. There is a catch with annuities, and there's always been a catch. Even in a kind of compulsory world, very few people ever kind of picked an index annuity. And what we think kind of going forward is fewer and fewer people will go for kind of a normal annuity. There is something about annuities that, even though they seem to tick the boxes of what people say they want, just, there's quite an emotional kind of reaction to that. So there is a kind of a wealth of literature, particularly in the US and in Australia, about why individuals say they want one thing, but when presented with that thing, they never pick it, or they only pick it if they come compelled to it. So kind of what is it? What's going on there that make people make these kind of seemingly conflicting decisions? So leaving aside the economic case of whether or not buying an annuity at age 65 is always a good idea for most people, and just kind of looking at the kind of behavioural drivers that we've seen from a lot of the behavioural literature around the world, and it's been backed up by our kind of consumer testing. And it suggests that a lot of the reluctance about kind of picking products comes down to emotional and behavioural drivers, and in effect, kind of savers aren't acting as kind of rational utility maximisers. They're acting like human beings. So if you didn't pick that up from the morning sessions, this is just to confirm it, that we're seeing the same thing. So there are many kind of emotional biases going on here. So I'll just touch on a few of these. Kind of firstly, the whole idea of present bias. So people, savers in their 50s and 60s, find this concept of they've saved for 20 or 30 years and they've got this big pot of money. This is the biggest piece of money they've ever seen in their lives. And then they hand it over to an insurance company, and what they get given back is a tiny, tiny income. And even kind of when you kind of explain, well, but this is going to last for 10, 20 years, if you add it all up for lots of people, you're going to get more than you put in. It just doesn't figure. People focus on the kind of shorter term. I've given you 100 grand, I've got 4 grand back. This seems like a bad deal. And it may well be a bad deal. So to kind of most kind of people we talk to in the kind of focus groups, and even fairly financially savvy people, this just seems insane. Why would you do this? And it just doesn't stack up. They want kind of something more today, and whilst they recognise that they may kind of need income into retirement, they're just not kind of picking up on the sort of future discounting and things. And I think that also goes into the concept of loss aversion. That there is this idea that when you hand it over to this other entity, you lose your pot, and they don't see it as gaining an income. And there's a lot of suspicion of insurance companies, there's a lot of suspicion of government as well and things. And this whole thing, what kept coming up in the research, and I've seen it in other research as well, is this idea that you hand it over, and I'm guaranteed to die the next day. And the amount of people who said that, you know, and the insurance company has stolen my money and stuff, and there's this real kind of emotional, sort of visceral feeling of theft, you know, people talked about that. And again, I think that goes into kind of another kind of emotional bias, this idea of kind of underestimating kind of low probabilities. Even when we explain to people, when we've taken people through all sorts of kind of basically financial education kind of sessions, showing people mortality tables, you know, there's a certain sense of fatalism, and it may be more of a British thing, but I think this probably goes kind of across the world, that it'll be me, I'll be the one who dies. You know, this is the kind of thing that always happens to me. So, and we've got some kind of great kind of quotes. In some ways, it's quite sad. People kind of gallows humour about it, but you know, this is just this is typical of what happens to me. So we have these people kind of really kind of focusing on the catastrophic rather than, you know, what's probably a fairly low probable event, certainly in the early years. So taking all of this kind of stuff together, so we have this product that kind of meets many of the needs, but for all sorts of reasons, it's kind of pretty disliked for kind of mainly kind of emotional, kind of behavioural reasons. So kind of Nest has been taking kind of this research and kind of pairing it with all of the academic papers about, you know, different drivers of behaviour. And we recently published a document called A Blueprint for Retirement, which tries to kind of balance this thing, giving people what they want, but recognising you know, some of the key kind of barriers to that. And basically, kind of what people want is a steady income, but they don't want to have to keep kind of checking this all of the time. And this is, you know, what we present to members or to savers and things, an income that goes up in line with inflation for most of your savings career. You don't have to touch it, it's all pretty straightforward. The key difference is that you can change your mind and you have flexibility to access it at different points. And I'll just go into a bit more detail of the kind of underlying mechanics, and I'll try and kind of skip on kind of quickly. What we're doing is we're basically splitting this into kind of three pots, which goes to the kind of mental accounting point that also kind of resonated quite strongly. So the first account is a flexible income account where most of your money would go kind of straight away, and that would pay out typically a 4 to 5% kind of regular income each year, going up in line with inflation kind of most years. And that would pay out for the first 20 years, so 65 to 85. We've also got a cash account, a kind of a rainy day fund, which meets a lot of the kind of biases that Brigitte was talking about. That things happen and you don't want to be digging into your income, your regular income. You need this kind of flexible liquid kind of pot. And then the final pot is the kind of burgundy one at the bottom, which is the idea of a later life protected income, which we would suggest the best way of kind of delivering this would be through the purchase of deferred annuities or some form of mortality pooling. But rather than handing over a big lump sum up front, which gets back to the biases I was talking about earlier, we're suggesting taking small monthly payments each year for the first 10 years, so kind of tiny premiums. So you get back to this concept that this is an insurance for you living a lot longer than you expected. And basically this can be kind of chunked, this entire kind of strategy can be chunked into three phases. So phase one, you know, the first 10 years of retirement, when you're practicing retirement, this is the first time you've been in retirement, you don't really know what you want. Super flexible, you can change your mind at any point, you can cash out everything you haven't spent, you haven't committed those kind of premiums, they're still yours, and that kind of really deals with you know, this kind of loss aversion and things. By the time you get to phase two, you've done retirement for kind of 10 years, and at this point we'll lock in those mortality credits to buy you your later life protected income. But remember, this is a small part of your pot, and you can still change your mind about the vast majority of your pot. And what we found in the research was somewhat kind of counterintuitively, as people go through and spend longer in retirement, they actually start feeling more confident about the probability of them living longer. Whereas asking somebody at 65, do you think you're going to live to 85? That's just, I don't know, that seems too complicated. But at 75, lots of people will be a large proportion of people will be kind of fairly healthy at that point and things. And then finally, we've got the kind of final phase, which is more like a kind of a traditional annuity where you get paid an income for life until you die. So there's a red lamp flashing there. So I'm going to stop. So I think just the last point I want to make is there are kind of plenty of rational economic reasons why this actually might make sense compared to more traditional approaches anyway. This isn't just about, we asked a bunch of people and this is what they said, and we looked at some literature, you know, there's a good blend. But I think our take is that kind of designing products and strategies that work with the grain of human behaviour and the biases that people present, rather than ignoring them, seems much more likely to be successful than just designing products that kind of fit more kind of economically rational people or what the investment models say. Thank you very much.
So I'm going to talk to you specifically about using behavioral economics to design products to help low and moderate income people save. So we all know this, Americans don't save enough, British people don't save enough either. It's a particular problem for low and moderate income people. Brigitte also had some statistics about how people can't come up with 3 months of expense or $2,000 very well, and for low income people, the majority of the low income people fall in this category. And also a very high percentage of people just worry about money. Okay. Now I'm going to argue that we should look at this problem differently, because I don't think it's really a savings problem. It's really, to us, dealing with volatility problem. And this is the reality for most low and moderate income people. It's not just that they have big spikes, their car breaks down and they have to figure out how to come up with the money. There's great research by the Center for Financial Services Innovation, and also very similar research internationally on the Diaries of the Poor about how volatile both income and expenses are for low-income people. Okay. So I do want to make one little point, which is this is not a solution for the entire set of low-income people. We should acknowledge up front that we can do all the magic we want around behavioral economics and better account design. For people on this A category, there are people who are just too poor. They don't have enough money to meet their overall income level. This is not going to be a solution for that large swath of the population. But for a big chunk of people, there's two situations, right? They either have just enough money, maybe a little bit more, but it's volatile, or they're just under. They have just a little bit too much, a little too little money, and it's volatile, but they could make little changes to decide to spend a little less or increase their income slightly by working more hours, taking someone into a spare room in their apartment, things like that. Okay. Now, what does this do for people when they're managing this volatility? It is a very complex juggling act. I think Eldar talked about this a little bit in his scarcity argument. But what does that really look like? What psychologies are going on for people? When expenses are greater than income, they have this big problem called tunneling. They focus to a very high degree on solving those immediate needs. I have to pay my rent. I need to buy food for my kids. I need to repair my car. I need to get gas in my car. They also have this problem with overconfidence, which is why payday loans are so successful. In the US, most payday loans last 2 weeks. So people say, oh, I have this immediate need, I'm tunneling on it, I'll take out a payday loan, and I'm super confident that in 2 weeks I'll have no problem paying it back. They often pay it back in 2 weeks, only to take another one out a few days later and get into this cycle of payday loans. So that's what's going on when expenses are greater than income. From a psychological perspective, when income then becomes greater than expenses in this volatility situation, present bias sets in. That's what's going on up top. We all know that very well. And they want to fulfill, they have money, and they want to fulfill immediate needs. They have this desire to consume, and they also have some self-control issues, right? Self-control is like a muscle. It gets tired and worn out. If you've just been under scarcity for a while, you've been struggling to make ends meet, and you're a little bit flush, it would make sense that then you're going to decide to give yourself a little treat, buy a little more, buy that pair of shoes that you've been wanting for a long time, or take your family out for a meal. So that's sort of what goes on, and those two tensions result in people having, even when they have slightly enough money, the volatility creates shortfalls and they don't have enough to save. Okay, this is all exacerbated by scarcity. Eldar, I think, talked about this morning, right? That people operating under scarcity have these deficits in terms of cognitive control, which makes it that much harder to deal with managing all of that volatility. Now, you might be saying, Josh, are you chasing a unicorn? in terms of trying to design a product that will actually help people. And here's the reason why people, I think, might often accuse me of chasing a unicorn. The first is that when you look at this from a bank's perspective in the US, this market, these products don't make money for people. It's very clear. We have a paper coming out very soon with Oliver Wyman they have all the data on how banks make money, which clearly shows that when you look at checking, savings, and credits accounts separately, banks don't make money off low-income people. They actually typically lose money. Now, the other thing is that, the other reason why I may be chasing a unicorn is that the current banking products don't meet customers' needs. These are statistics on people who are unbanked or underbanked in the US. So 1/3 of people either don't have a bank account or they rely on alternative financial services. And they spend typically $1,100, so that's probably around 700 pounds and change a year on alternative financial services. So they're spending money on financial services. So it does seem like there should be a revenue stream there for the banks. Okay. Now, what we're going to argue is that there's a need for a more integrated product. And when you do the math on an integrated product, when a bank says, okay, I'm going to offer these things together, and I'm going to offer them in a tightly integrated way with some behavioral tweaks, the bank actually starts to make money on the account, and the customer's better off. This has to do with things like if you offer people both savings and credit together, knowing that they have some savings means that they're less likely to default on their loan. It also means that if they have access to credit, they're more sticky and likely to stay with you as a customer, so the duration of the account, something that banks care a great deal about, is longer. And what it does is it turns middle income and low to moderate income consumers positive in terms of profit for the banks. Okay, now the funny thing about the design of this account is when you look at it, you say, that's kind of what I have, right? You have income that comes in, you have access to credit, you pay your bills, you have money for spending, and some goes into savings, and it's, for most people, automated in some way, right? Now, for a low-income person, it's much harder to get that product. Some of it starts with, or to bundle those products together themselves. Some of it starts with the fact that credit is a real problem. It's much harder to get credit at a reasonable rate. But some of it also has to do with the fact that all that kind of bundling you do together relies on you having a fair bit of slack. They have very little slack in the system. So you need to have the products tightly integrated together, but you also have to have a number of behavioral components to make the whole thing work. So I'm going to walk through each of these and sort of explain why we think it, from a behavioral science perspective, will work well. Okay. First is a need to limit discretionary spending with automatic partitioning, commitments, and feedback. So you saw that point. There are times when low and moderate income people actually have money. It's kind of a bumpy road. Sometimes they're flush, sometimes they're in the negative, right? And so the question is, can you help them through their own identified desires, limit spending in those times when they're better off, and then they can use that to develop savings or pay down credit. So one is this first idea of mental accounting. You can see back in this slide that income comes in and it automatically gets partitioned, some into these reoccurring bills and some into the discretionary spending, and if there's some left over, into savings. The other thing is that you allow them to make a commitment about how much they're going to actually spend on the discretionary side. So this is Dick's Save More Tomorrow, where people are committing in the future to save something. You can also make commitments about wanting to limit your spending. And then you have to have a product that actually shows them feedback on that. This image here is actually a prototype product. It's a little fuel gauge, a credit card, where you imagine swiping, and there's a digital fuel gauge that decreases. It could be on the credit card, or it could be on an app. But real-time, very real-time feedback would be important. Okay. Incorporate savings into credit. So this has been done by a number of credit unions where you take out a loan, a relatively short-term loan, and you pay it back, but you're paying a little bit more than both the interest and principal. At the end, you end up with savings. So that automatically goes into your savings bucket. So people need credit, but at the end of that credit process, you want them to start to build up the savings. Automatic bill payment while retaining control. All the managing of the bills, we talked about the cognitive control, managing the bills, making sure they get paid on time, is actually a significant hassle for people. It takes up a lot of bandwidth, and they make mistakes and pay late fees. That's some of that $1,100 has to do with de facto late fees that they end up paying on bills. However, we've piloted this automatic bill payment. People don't like it because they feel like they don't have control. What they want is they want to be able to see that it's automated, but then be presented with each decision that says this bill is going to happen and this is how much you have left in your bill pay account. Because they're worried there's going to be some other expense that the system doesn't know about that they need to account for. Okay, automate savings. So this is pretty obvious, but you also saw in that bucket how when your income comes in, it gets divided up in some ways. Allow them to commit. It can be to a very small amount of money that they're going to automatically put into savings each month, and therefore typically by slightly reducing their discretionary spending. Smart reminders and alerts. So in situations either where people aren't willing to sign up for automatic savings, we would suggest that there be smart reminders and alerts about opportunities to save. And because you have that whole bucket of the transaction account, the savings account, and the credit account, you would know when what their average income is coming into the transaction account and when they might have more income, and then be able to send them a reminder, this might be a good time to save. The text could even say, text us back if you want to save now. And this is a study done by Dean Carlin, Zinnemann, and Simmelman Nathan, which shows the power of just simple reminders around savings. Okay, and the last one is behaviorally designed coaching session. So you've heard a number of times that financial education is basically a waste of time, and John Lynch's meta-analysis proves that. Now, coaching is sort of questionable. It seems like it might have some impact. The problem with coaching is it gives people a bunch of homework. We designed a coaching session that instead is all action-oriented. So it's a very simple budget exercise you go through, and then you make commitments. People sign up for things like automated saving or automatically paying down credit. We've piloted this with a credit union. You can see there that people actually save significantly more in the treatment versus the control. So just in closing, it's those components together that would make the difference in this product. And currently right now we're piloting this financial health check. That's what we call the smart coaching session. But doing it in a more cost-effective way with mobile appointments on the telephone with a credit union, Boeing Credit Union, and we're in the process of recruiting banks to try out the integrated product. Thanks.
We're going to move into the Q&A session now, so if you have questions about the different kind of approaches, then do raise your hands. Oh, I was going to ask the first question, but maybe I don't think so. Should we go ahead?
Thanks. Joe Gladstone from the University of Cambridge. So a cynical person might say that financial services works as a big game, and the game is called find poor people and make money from them, and give the money in rewards to richer consumers in terms of freebies with their credit cards, bonus rates on savings, things like that. And so the problem we're trying to solve this problem of savings with products, which is something that Josh suggested, is that what most behavioral insights, when we try and help people with them, is that the more sophisticated consumers are the ones who are most likely to take them up. And so if you take that cynical approach that says that richer people are already winning the financial services game, then offering a product that's more likely to be taken up by sophisticated consumers isn't going to solve the problem. That's just going to change the bank's approach to increase fines, increase overdraft fees, reduce things in a way that is still probably suboptimal to the kind of bottom quartile of society. So I wonder if we could just talk about some of the unexpected externalities that might come with trying to solve the problem through products, and if that's going to take into account in the work that you were doing with ATCAMI or
Sure. So, we've talked to David Lakeson about this issue exactly, and he's written a great paper about this idea of sophisticates and unsophisticates. In this case, actually, there's a couple things going on in the marketplace in the US. So right now, overdraft fees are a big way that banks make money off the moderate income consumer. It is highly likely in October that is going to be heavily limited. And then banks are going to start to look for, is there some other way that we can make money on this consumer set? Because the big piece that exists now is going to go away. And so we think if you present an option to the banks, and you can be cynical and say they're not going to go for it, that is a different approach to it that still allows them to make money, but actually makes the consumer better off, and capture some of that fee income that they're already spending on other financial services to pay bills through money orders, to cash checks, to get payday loans, that's a win-win. So, I mean, that would be my perspective. And I don't think most middle income or upper income statisticans aren't going to take this product because they already have the product. They just don't have to manage with such scarcity in terms of no slack in the system.
Let me add a couple of things to that, not specifically to Josh's product, but I think I'm sympathetic with what you are saying. In the US, there are institutions called credit unions. I don't know if there's an analog here in the UK, but they are not, for-profit, shareholder-owned enterprises, and their financial incentives are a little bit different. And Ideas 42, I think, has done a fair amount of partnering with credit unions, probably because they're more open to it for exactly that reason. So I think there are some financial institutions where these ideas would be more feasible from a business perspective. Secondly, I think there's a lot of room for employers to come in. So for employers, the incentives are more aligned because when their employees are under financial stress, that shows up in job performance. And matter of fact, in the US, many of the credit unions are employer affiliated credit unions. So it might not be that the big name brand financial institutions are going to find this hugely attractive, although they might. But I think there are other ways, other institutions, employers and not-profit driven financial institutions that could do a lot in this space.
Yeah, sure.
So I agree as well. I think there is a problem here with industry and the cross-subsidy you're talking about. But I do think it's important that businesses are trying to design products which meet needs just like this. I think in the UK context, part of the problem is that some of these things already exist, so people are already launching accounts that allow you to have flexibility over when you pay, direct debits for bills, or give you kind of jam jar type functionality. The issue is that consumers don't want to pay. So they either don't want to pay or they aren't engaging in the first place. So here's a plug back to my idea. So the idea is turning it around to force banks to engage more with consumers. If you're forcing the banks to engage more, to go and sell the product that they have more aggressively, to say, here are the advantages of the product that I have for you and here's what it's going to give you, rather than just sitting there and frankly giving them a quite basic bank account which charging them for an overdraft, doesn't give them any functionality for savings. They're doing pretty well at the moment, they've got no incentive to do so. If you make them earn less money by restricting where they can put their customers, there's suddenly got an incentive to go and try these accounts and actually put forward something a bit more exciting for the consumer.
Right, we'll go to the gentleman in the green jumper on the aisle, and then we'll come forward. Thanks.
Hi, I've got a first question for Brigitte. When you were talking about the savings rate in the US, and I don't have the figures to hand, so I plead ignorance on those, but I thought one of the key differences was that in the US, tax is paid annually by your own self-assessment, as far as I'm aware, for lots of people, and therefore there's more of a cultural capital in terms of saving money for payment. Whereas in the UK, most people's their tax is taken at source, and therefore they are used to saving large amounts of money. So this was this question that came up into my mind: that will we ever really get over that in the UK? Well, most people are never forced to having to make saving commitments on an annual basis anyway. I thought about myself in this. I don't have 3 months savings. I've no reason to, because I have insurances, etc., etc. I feel no need to have 3 months savings.
I mean, that's great. If you've got insurance products that have you so well covered, that's a huge victory for the structure of the insurance industry in the UK. I don't know enough about it to know whether everyone else in the room would agree with that or not. It's true. So in the US, the tax system is, taxes are withheld at source for most people. If you're a wage and salary worker, if you're not self-employed, your employer is withholding taxes. Most people have it set up so their taxes are over withheld, so at the end of the year they get a refund. So it's forced saving to some extent, and people like it that way. But most of what people do with that tax refund when they get it is they spend it. So it's forced short-term saving that then gets used on a vacation or a down payment for a car or something like that.
The other thing in the US is that, particularly for the rainy day population we would care about, we do our income redistribution through the earned income tax credit. So most people are actually getting a massive income subsidy, often 10 to 15% of their income, through the tax system. So they also, it's funny, they don't think about it as something being taken out of their check and saving. They think of tax time as a big income moment.
So overpaying tax is probably the next big idea. The lady at the front? We probably do need the microphone. Probably for the people at the back.
Hi, hello. Veronica Humble, Legal in General. My question will be around kind of to what degree some of the issues can be addressed with US-style safe harbor. For example, I know that this exists in the kind of in the savings accounts and in the pension schemes, but in retirement as well for the US and in the UK, both in terms of retirement, in terms of charges for or rates that you pay, you get in banks, etc. So what's your take on this?
Well, for pensions in the U.S., many companies were reluctant to adopt automatic enrollment where it's not mandatory, so it's done on a voluntary basis, until the U.S. government put in place some safe harbors so companies knew they wouldn't be facing legal liability for garnishing wages from employees' paychecks, or defaulting them into an asset allocation that had some risk associated with it. And as soon as those safe harbors were put in place, employers were suddenly, or at least large employers, much more receptive to the idea of automatic enrollment. I'm not sure what the regulatory status is in the UK on this front. In the US, if you wanted to set up the parallel emergency savings account that I talked about, you would need another set of regulatory safe harbors, because the same issues that kept employers from adopting automatic enrollment for retirement savings, those same barriers exist for automatic enrollment for any other type of savings vehicle.
It's almost exactly the same here in terms of the regulatory kind of requirements. There is a safe harbor for employers for automatically enrolling people into products. And then there's a requirement about what those products are. Sorry, but
So I think in the decumulation, there's a real challenge in terms of the governance, and I think what we're seeing is actually a lot of people stepping away from taking responsibility. So we have this kind of great accumulation kind of phase with automatic enrolment, with the safe harbour that comes with the automatic enrolment legislation, and for those schemes who are under kind of trust-based kind of law or independence governance committees, you have this kind of great kind of governance kind of role where people are being looked out for by, hopefully, people with fiduciary duties. There is a bit of a danger that they then get to 55 or 60 or 65 and they're being put into products that have kind of probably FCA kind of regulation, which is about treating customers fairly, but that's a very different kind of regulatory regime than what you've got in that kind of trust-based or kind of more highly governed kind of accumulation phase. And I think that's going to be a big kind of challenge going forward. Who's going to take responsibility, particularly for those people who, for whatever reason, just struggle making kind of difficult financial decisions and are unwilling or unable to pay for financial advice, and are certainly probably unwilling to pay for it more than once, whereas all the products coming out require kind of annual reviews, and all of the onus has been put back on the individual, that you're responsible for your retirement in a way that perhaps isn't there in the accumulation phase.
My name is Carla Huff. I'm at the World Bank. I had two quick questions. The first is, do you foresee that there will be new regulations on the information transmission to savers? You know, you want savers to monitor what they're doing, but they may be having multiple sources. And how can they compare? And, you know, the way in which information is presented by different financial agencies and by the Social Security Administration and maybe by the local pension fund, it's all kind of hard to put together. And we know from scarcity that people have very limited cognitive resources. So if you're asking them to be subject to the kind of social norms where they compare themselves to others, they may not even fully understand what their own situation is. And I wonder if that's something that you foresee regulations could possibly address without violating privacy rules, and will. And then my last question, I'm not quite sure who could answer this, is that an issue that's been raised, for example, by Ann Case in evaluating interventions to promote savings in poor countries that have used mental accounting, is that if you keep reminding people, oh, they have to save for their kids' medical expenses, for example, then maybe when their neighbors have great urgent needs, they're less generous. So maybe, at least for very poor communities, making people more conscious of their savings actually diminishes the informal insurance market, and so the net benefit is ambiguous.
Well, I would take that first point to be a vote for Matt.
I think it is. I think it is. I want already.
I think your first point was basically what Matt was suggesting, was around, kind of a dashboard or something that actually brought together all of that information so that you could see where you were and then perhaps give you advice about where you ought to be.
That sounds so fine and guidance. I mean, why isn't every prime minister saying he wants to do that?
I'm going to vote for Prime Minister.
Private industry is doing that to some extent. So in the US, there's a company called Mint, and if you sign up for their service, they have a financial dashboard that will hook into most of your financial account providers and do that aggregation for you. The big piece that's missing, at least in the US right now, is Social Security, but I think Social Security is actually thinking about ways they could make their data, available to help facilitate that kind of overall account aggregation. So I'm not sure how much regulatory change you need. It might depend in part on what the private sector can do and can't do without the regulatory change. The UK, you might need more change than in the US.
I didn't know the private sector could do that in the US without violating privacy rules. So you're telling me there's some company named
Mint.com. Yeah.
There's a UK equivalent called Money Dashboard.
Okay.
There's also
One at a time.
enrolment. So you just, if you download the app and then you put all your accounts to go get every month, and you have the dashboard.
Yeah, that's what Mint does, only they do it every day.
Okay, well, that's less votes for Matt, because it already exists. Oh, okay.
So, I mean, you're right, there are problems in the UK at the moment, and it's not my idea, it's an idea which has been banded around, particularly with respect to pensions, but not the wider pension savings investment landscape. There are issues around regulation, so for instance, at the moment, if you gave a company your login details, your bank account, and so they can aggregate all that data for you, you're basically breaching your agreement with your bank, and so you aren't covered for fraud anymore. So there are some serious questions for the regulator, for the government, about how that's tackled, how it's taken forward. And I think there's a consultation at the moment. Underway. So really just trying to think about how that's taken forward. So to your point, how we can get that information in the right way, in a consistent manner, so people can try to understand it much more clearly.
I would just add quickly that there's a big behavioral problem with the Mint model, which is if you go to Mint and ask them what their problem is, it's signups. So the process to register and sign up for Mint is like a big hassle. It's a pain in the ass at the beginning, and they have a drastic fall off from when people start that process to they finish the process. So, in the neighborhood of 16–17% of people actually complete the process of putting all the information in and using Mint. So that would argue for some way to figure out a way to do it through the pension system in a defaulted way so you saw everything.
Okay, right, I'm going to be very British and we're going to take 3 questions because there's quite a lot of people who want to get it. So the lady in the second row, and then we'll take the gentleman in the third, and then we'll go to someone near the back. Yes, okay.
Thank you. It's all very interesting, but one of my concerns is how do you address the conflict of interest, for example, between the industry, the banks, in Brazil, for instance, interest for credit cards can be as high as 15% a month. Would they give up on that to encourage saving? I mean, you know, where they will get maybe 0.5% a month or something. Do you have any ideas? Like, for example, the idea about the credit card is great. You know, the indication there, the feedback. A student of mine once suggested that it would give shocks. Once you're about to overspend the credit card, you know, gives you a shock. But you know, how
that would require regulation.
yeah, I'm afraid so. How would you? Would we need nudges for the industry, or you know, regulation? What idea?
Should we go to 3 questions? It's the gentleman there.
Thanks. Renda Sariaska is a UK Financial Conduct Authority, so it's great to hear many fascinating ideas. And I had 2 questions, quick questions, one from Brigitte and one for Matthew. So my first question would be to Brigitte. So you kind of proposed splitting the piggy bank into 2 compartments and making consumers think of them as different mental accounts. And I wonder, do you see any risk in that idea backfiring in a way that by making one of these 2 accounts more accessible, you kind of could induce people to think, I'm going to read it this month, and next month I'm going to refill that one, and from then on I will be saving for my retirement. And do you actually see a way of testing that idea empirically going forward? So that's my question for Brigitte. And my question for Matthew would be, so your idea was to suggest a sort of floor on the interest rate that would be benchmarked against competitors in the market. What do you think would be the industry-wide response or result in return to such a regulation? Thank you.
And the lady who's just in the kind of pattern shirt. That's most in there, but...
Hi, my name is Rebecca from the Bill and Melinda Gates Foundation. So automatic defaults and automatic savings works, but it's most effective if you have a bank account and you have an employer that's making regular contributions into that account. So in a situation where you have someone in a small business who has to, isn't getting paid a regular amount into an account, or for us in developing countries where people often don't have a savings account or in the informal economy, they're earning cash. In the absence of kind of automatic kind of actions, are there any kind of behavioral techniques or nudges that you're aware of that can get people to A, open an account and have a savings instrument, and B, to create those kind of regular habits where they're able to start saving when you don't have the kind of structures that are available to consumers here?
Thank you. Right, we'll come back and answer all those 3 questions. Are we finishing at 1:30 or 1:45? Oh, okay, that's fine. I'm just going to answer your question, if I'm allowed to. I think, certainly in developing countries, the technology on phones, and the proportion of people who actually have mobile phones and using that to kind of bank and save. I was speaking to colleagues in India, and that feels to me to be one of the ways actually we could import in here, in terms of actually getting people into the savings habit and using that sort of technology to try and get people to save rather than necessarily having to have banks. I was talking to someone there and they said that banks would be defunct within about 10 years. Do you want to answer the question that was directed to you?
So the question was, do I worry that if you give people too much money in an emergency savings account, that then defeats the goal of retirement savings because people just keep on raiding the non-retirement savings piggy bank. And I think the extent to which I worry about that really depends on how you set the system up, and that's why I suggested that you would not take the amount of money that's deducted from the paycheck and put it all into the emergency account until the emergency account reaches the threshold, and only then start putting money in the retirement account. I think it's key to be putting some amount into the retirement account all along. You fund the emergency account slowly. So if I raid it all this month, it might take a year before it's replenished. And meanwhile, I'm always putting some money into the retirement savings account. And you asked how would I go about testing this? And that's a fantastic idea. I think you would want to test this, and the way you would do it is you would have a different division between the two accounts, how much is going into the emergency versus the retirement account initially, and perhaps also a different threshold amount for the retirement or for the non-retirement savings account, 3 months of pay or 6 months of pay or 12 months of pay, and then you watch and see what happens, and then you reformulate your policy accordingly. Let me also chime in with one study for the person from the Gates Foundation. I agree with Charlotte that I think mobile money has huge potential in developing countries. But there was a really interesting study by a couple of psychologists looking at day laborers in India paid cash wages, and the technology that they used was envelopes. And they set a savings threshold, and they put the money into actual envelopes, and that particular study, the interventions they were trying were, do you put the money in one envelope or two envelopes? And you got a lot more savings if you put the money into two envelopes. And the reason was, a lot of people had to open an envelope because they had financial shocks, and if you open an envelope, you spend everything in the envelope, and that's your concern right here. But if you have it in two envelopes, the likelihood that you have to open both envelopes goes way down. So that's a very simple technology. Now, it requires some cooperation. It requires, in this case, the employer or the study researchers to go in and divert part of the paycheck into an envelope. But I think you have to deal with the technology you have at hand and be creative.
Yeah, no, it's great. Who did that study?
Soman and Chima. Dilip Soman and Amar Chima. Anyone else want to chime in on the other questions?
Matt's going to answer his question.
Do I have to?
Yes, you do. And then I think there was a broad question around institutional reform, which is, banks and insurance companies the problem, I guess, which I'll certainly ask Paul's opinion on this.
So it's a really good and hard question. I'm going to start with, while I continue to think, with some stats to show how big issue it is. So your own report, the FCA's Financial Savings Market Study recently showed that in interest in easy access accounts, around a third of all balances in the UK are held in accounts which are opened over 5 years ago. So that's over a third of balances there. Those accounts pay only around a fifth of the interest that accounts opened in the last 2 years paid. So there's something really quite big going on here, that there's a lot of people with a lot of money in very old accounts which aren't giving them very good value at all.
No pressure, but we're expecting that
So it is a big problem. I mean, sure, if you're telling banks they're going to have to pay higher interest rates for people who are moving off the bonus rate or off the kind of fixed term account, they're likely to reduce some of those bonus rates, and they're likely to reduce some of the top rates across the board. It's to the point just here, do we want to live in a world where the most savvy of us, probably all of us sat here, switch quite regularly, get the best value from our accounts, and then the people who actually probably need to save more don't switch, don't get good value, and are left worse off and rely on the welfare state? I'd argue that perhaps we do need a bit of rebalancing to give people who aren't potentially quite so savvy a better chance to be able to get a higher rate of interest. You would hope that the businesses actually took it upon themselves to actually compete on it though. There's no reason why they have to behave like that. They can start, to the second point I guess, they can just start offering better products and trying to compete and win customers, rather than just sitting there being happy that someone's come on them once and then just sit there for 5 years. If we increase that level of competition, they're going to have to get better products, offer better rates. The point here, can we get a snazzy all-in-one account that does lots of fun things that people are actually willing to pay for because banks are competing? And so I don't think it has to be all doom and gloom. Short term maybe some rates will come down, but hopefully it will change the market and actually banks will start to compete and play fair.
Do you worry that they'll manipulate? So we just came off of a LIBOR rate manipulation scandal, which I think has some parallels to what you're proposing. Do you worry about collusion or manipulating?
Paul, do you want to add
I think probably if you'd ask me, kind of, sort of my background is government, so my natural inclination would be to regulate. But I think the experience that the UK have had with automatic enrolment and the creation of an entity like Nest, which has kind of slightly different motivations than perhaps some of the previous kind of players in the market, has actually had a quite, it's quite startling effect in terms of things like prices, in terms of things like quality of communications, in things like innovation in investment. So when you place a kind of a different entity into the pool, the sort of the ripple effect, the halo effect of actually this is another business which has a kind of a slightly different business model. In many ways, I'd probably say that's arguably better than trying to regulate, because the more you regulate, regulators can never kind of keep up with loopholes and things that people create. Whereas if actually what you're doing is trying to create kind of genuine competition. I mean, a lot of the problem in all of these things is that probably competition doesn't really work. There's such asymmetry of information between the suppliers of financial services and the consumers that, to a certain extent, it's just obvious people are going to get ripped off in certain circumstances. But if you can put other players, and I think the kind of credit union kind of model, and say in the UK, you'd say the cooperative, but perhaps that's not such a great model after some of the things that went on over the last 4 or 5 years and things. But organisations with different kind of motives that aren't kind of purely profit motive, I think can actually have a really beneficial effect in the institutional landscape.
I think we've got 10 minutes left, so I think we probably do have time for kind of 3 more questions. Could you keep them quite short, though? I think the other thing is, I was going to ask if anybody has an idea that they feel is better than the 4 that they've got. If they could do that quite quickly as well. So 3 more questions. Should we take the gentleman on the side here, and this lady, and the gentleman. Sorry, I'm really sorry. We've got more questions than we have time.
Hi, my name is Chris Bryant from the University of Chicago. The question's for Brigitte. It struck me while you were talking about your plan that if it were successfully implemented, it might open another opportunity to free up money for savings, and that is that if you have a rainy day account, you could afford to have insurance with much higher deductibles, and that's less expensive. Can you think of but less heavy people are unlikely to take advantage of that opportunity. Can you think of a way to automate that piece of it? That's putting on the spot.
Question for Brigitte. I've forgotten her, and Victoria didn't have.
Hello, Ellie Waters Environment Agency. My question is one about disempowerment, and I think it's really great that we are moving people to automatic enrolment because it does help solve the pensions problem later on. I think it also maybe puts people into a position of disempowerment where they then expect somebody else to do it for them. And I think, how do we balance the helping people provide for themselves while still letting them know that it is their responsibility and they can do things and they have that power?
Good question. The gentleman.
Hi, I'm Jörg Weber from the University of Nottingham. I have a question for Brigitte and Charlotte. So it appears to me that we actually know quite little about the net effect on savings of auto-enrollment and nudges. So the only study that I know of that does that quite well is the one, well, very well, is from Russ Chetty that Richard Thaler mentioned this morning. So my question is, how are we going to analyze the net effect of auto-enrollment and nudging in the US and the UK?
Taking Brigitte through our evaluation plan. She was asking me the same question yesterday. I think I said several years as a couple of PhD students. We did get our 3 questions, but this lady has had her hand up all through, so I thought we should probably...
Thank you. Hello, I'm Kirsty Boneborn from the Money Advice Service. So there were just 2 quick points I wanted to ask about. So the presentations you gave were very product focused, which I assume was the brief, but I'm interested in your opinions on the following 2 areas. So the first one is around supporting the next generation, not to have the same cognitive biases that we do. We're not born as being good or bad with our money. Many of the executive functions and cognitive ability around being able to delay gratification, being able to plan ahead, are developed throughout childhood. We know that self-control at the age of 12 is one of the strongest predictors of future savings behaviour, and we know that that can be learnt, it's not necessarily innate. So what is the role for interventions involving children? The second is around, at the moment, our reliance is on for financial services to solve the problem through a product. But that means we need to make a business case around why it's important to them that we don't have yet. Have the panel considered the lack of savings as a public health issue? For those of us who are working in it will know really well around the impact of over-indebtedness. There are 8.8 million over-indebted people in the UK. A third of those who have sought debt advice have either or considered committing suicide. Some of you might be aware of the recent Iceland research, which shows that during the economic crisis, birth rate of babies was significantly lower. So is public health something that we should be considering around savings behaviours?
Great, thanks. Do you want to take the question that's specifically to you?
Okay, so I've got something to say on all of these. So I'll take the gentleman's question first. So you're right, Chetty and Friedman et al. Is the only paper so far that tries to look at the net impact on household balance sheets of automatic enrollment. In fact, they aren't able to look at everything. They've got many sources, but not everything. It's really hard to get this data. My little research team's been trying for 8 years to do this study in the US. We have just gotten permission to do a piece of it, not all of it. So we've got 5 organizations for whom we have administrative data on savings, and these are companies that have implemented automatic enrollment, and we've gotten permission to do a credit bureau data poll, so we'll get all of the consumer borrowing. So we won't be able to look at credit out from other savings accounts, but we will be able to look at if your employer takes more money out of your paycheck, does that mean you then borrow more on your credit card because you've got less take-home pay? So there are people working on this, and it'll probably be some time before we have a full answer, but it's an important question. To this gentleman's question on, I think you raise an excellent point, which is if you get people to have more money in an emergency fund, they can choose lower deductible or higher deductibles on their insurance, and that is generally a cost-effective thing to do. And what you would really like to do is to be able to have the insurance providers integrated with the savings account so that you can then allocate that savings on the monthly insurance premium into the emergency savings account, which would be fantastic. But I don't know of that happening anywhere. On your question over here about, or your comment on the public health implications, I completely agree with that. My research group and others in the US are always trying to make the case to our National Institutes of Health, which are the big funders of health-related research, that they should be funding research on savings as well as health, because the two are tightly integrated. And one of the really interesting findings that came out of research that Amy Finkelstein from MIT and others did on the Oregon health insurance experiment, you either know what that is or you don't, but basically a bunch of poor people in the state of Oregon in the US were randomly given health insurance, and one of the interesting findings was that they were much better on a variety of mental health measures after that, and the working assumption is because their financial vulnerability went down. And then to the last comment over here on, does something like automatic enrollment kind of disempower people? I'm going to turn that around by asking you a question, and I'm going to take a risk in doing that. Do you grow all of the food you eat in your backyard garden? There's going to be quite a lot of that. Do you fix your car? When your car needs repair, do you fix it on your own? Do you feel disempowered because you can't fix your car on your own? No. You probably feel empowered because you don't know how to fix a car. And if you had to do it on your own, it would be very frustrating and it would take away mental capacity from all the other stuff you would rather be doing. I think automatic enrollment can be empowering because there's a lot of research that shows that people are much more confident about their financial situation if they have an employer savings plan that's helping them save for retirement. And so I think I can see the disempowering aspect. You don't have to worry about it, you're not thinking about it. But on the other hand, knowing that you have financial resources available for you, I think can be very empowering, can reduce the amount of financial stress. It's a little bit of a trade-off. I do think there are ways that even with automatic enrollment, you can you can have engagement around that even though it's happening automatically. Much in the same way, for people who aren't growing very much of our own food in our gardens, I don't grow any of my food in my garden, right? I don't feel disempowered at all about that, and I'm just making different food-related decisions, right? Instead of making a decision about, what am I going to grow, and am I going to pick the weeds today, and how much am I going to water, I'm making different decisions. So I don't think it has to. I think it could be disempowering, but I don't think it has to be.
So I just want to comment on a couple of them. On the question of the kind of full balance sheet, I think there is this promising opportunity with JP Morgan Chase. So they've now set up this new research center, and academics can apply to use the data, and it's massive in terms of the amount of research that data they have on their customers, and I think they'll have the full picture on something like that, and you could actually parse it out and use that data. On the empowering question, so the funny thing to me is that I would be concerned about that if people didn't actively want that thing. They actively and have an intention to save more typically. And that's what auto-enrollment does. It's a matter of sort of like taking a hassle out of the way or making it happen for them for something they already want. You could switch to forced choice. Forced choice basically, if you do forced choice, sit people down in a room and say you have to choose, you get basically the same result in terms of the enrollment levels. It's just much more time consuming. And then to the question around mental health, in the US, it's compounded because we don't have universal health care. And the number of people who have serious debt problems as a result of medical debt, it's over like 50% of people who have serious debt problems are a result of medical debt. So the issues are very intertwined. We wrote a paper recently called Poverty Interrupted, which is highlights and connects all these things together, both the poverty aspect, the child development aspect, and the financial aspect, and start to look at solutions to deal with that.
Right, I think we're almost out of time, so I think this is enough time just to do the final voting. Actually, before we do that, we should probably thank our panel. Otherwise, we'll just think it was the winner who was getting the applause. Right, so you're back on your, I don't know what you call it. So, which idea, if you only had to choose one, would you support? So, vote now. You don't get to vote here.
It's finally fulfilling my dream to be on a reality.
Right, and... Oh. No, it will. Brigitte, congratulations. Actually, we should just give a round of applause to Kate, who has organised this session. Most of you can't see that.
Yeah, you can't tell, it's a piggy bank.
This has not been thrown together. This has been well thought through.
I need two of them.
We'll get you another one. Right, thank you all very much. I think if there's a break and then we're back in the plenary session. Thank you.